we've already looked at the optimal size of a firm, and now we want to look at is when you have transactions that take place within firms, how do you maximize the profit, or how do you make sure that the different divisions work for the interests of the firm itself? And so we're going to look at different corporate structures. So first off, remember the issue with Delta purchasing the refinery. The argument was by Delta that they would be able to get gasoline or get their jet fuel at a lower cost, which is going to save them money. However, there were some issues that they were struggling with, and the biggest problem is they looked at the refinery as a cost center, which we'll talk about in a little bit. But a firm will, usually produce multiple products or have different divisions within the firm, and having that, they have to focus on what they're doing and how they transact within that firm. And that's what we're really going to take a look at with this video. Focusing on just one passenger and one freight service while neglecting others is a bad way to do business, and that's really the mistake that Delta made. And so we'll see what that happens. And what it all comes down to is information and incentives. And oftentimes, without, as opposed to a top-down command and control corporate structure, having a flatter corporate structure is more beneficial, or having markets within a firm is beneficial. And that's what we're really taking a look at, is how these information and incentive problems can be solved within a firm. So we're going to look at four primary types. Well, there are four primary types. We're really going to just look at two. The first one is the functional or the U form. And this would be your typical firm that has an accounting division, a marketing division, a production division. Multi-divisional firms are a little different in that they're structured around a certain product line. So if you look at something like Disney will have the animation division, it will have the amusement park division, it will have the movie division. So they're different product lines that they're focused on. A flat corporate structure is one where you're seeing more and more of this now, where there's really not a top-down command and control leadership. There are still managers in a firm, but it's a flatter organization across all employees. And the last one is a matrix, which is a much more complex structure, involves kind of a mixture of all of these. But again, we're really going to focus on just the first two of these for this video. So the first one is a functional form. And again, this is where the responsibilities are divided into functions, where you have the accounting responsibilities, the marketing responsibilities, design, production, and Southwest Airlines is a representative of this type of a corporate structure. It has your marketing division of Southwest, it has your the finance division, it has the accounting division. These are all within that one firm. And the benefits of having this is workers really specialize and develop expertise in a specific area, much like accounting or marketing. Performance is typically easily measured, and so tying pay to performance works pretty well because you can see what they're doing, and information is easily shared within a department. So there's not a lot of negotiation which you might have between departments. In this case here, information within a department, any department, is pretty easily done. The problems with these, though, is that the behavior between different divisions has to be coordinated, so it needs a lot more oversight from a CEO. Case in point would be a division, say the design division of some company, that creates a design that really is much too costly to implement by the production division. And therefore, there's a lot more coordination between the design division and the production division for that to happen. Marketing department of a newspaper, for example, accepts a contract for advertising inserts, and the process of printing and getting this inserted into the larger newspaper can impose huge costs on the press or the distribution division, and that's something that's not considered without the oversight of a company. It's also true that divisions may game results in order to receive bonuses. So, for example, they might want to bring forward sales that they might have taken a year from now and defer, or months from now, and defer costs in order to achieve some budgetary goals. And this is more likely to happen when you have a functional form of corporate structure. The other one is multi-divisional. And so if you look at the multi-divisional companies, we looked at Mervyn's already. We'll take a look and see what they did. Hewlett-Packard, Disney, General Electric, and banks are set up for the most part in multi-divisional forms. You might have a commercial lending division, a mortgage division, a loan servicing division, a banking, retail banking division, and these are the corporate structures you'll see. HP has a computer division, a printer division, and even within the printer division, they'll have a toner division that sells toner. Disney, as I said, has the animation division, has the movie division, has the amusement park division. Those would be multi-divisional forms of government. GE has GE Capital. It has the electric appliance division. It has the corporate commercial division of GE. These are the multi-divisional forms of a company. Now, the benefits of a multi-division is you can easily monitor and measure the profitability because they're going to be based on each division is going to be a profit center. So profit motives will increase productivity and innovation within each of those divisions. For example, if I am HP, I want to continually try to innovate on the printers in order to maximize the profits of my division. If I am let's say a furniture manufacturer set up in different divisions, then I want to come up with new designs in order to maximize profits within that division. And there's also greater resource allocation within a firm. And that's because the different divisions have an incentive to allocate resources most efficiently in order to maximize profits within that division. One of the biggest problems, though, is since divisions are independent profit centers, they each have an incentive to act in their own interest, even when doing so hurts the firm's interest or adversely affects the larger firm's interest. And we're going to take a look at why this is a case and what's important about this. And so when you think about this, we're going to look at what we call profit centers and cost centers. So let's start with Mervyn's. As you'll recall from earlier in the semester, Mervyn's was acquired by Dayton Hudson. Dayton Hudson really didn't do much with it, and it really wasn't making a lot of money. It wasn't losing money, but it wasn't doing so well, so they ended up selling it to an asset management or consortium of asset management companies who immediately after looking at the books realized that a lot of the properties were owned by Mervyn's, but they were not looking at them as the opportunity cost of the buildings themselves in which the Mervyn's retail outlets were established. And so immediately what they did is they separated the company into two different divisions, the retail division and the property division, and then they had the property division charge the retail division market rent. And shortly thereafter, Mervyn's went bankrupt because it technically was a bankrupt company. They were not charging themselves the rent, but it didn't mean that rent, the opportunity cost, wasn't real. And so that would be a problem with Mervyn's. They were operating as a cost center as opposed to a profit center. Same thing with Delta Airlines. It too was operating as a profit center, as a cost center rather than a profit center, or it still is. And the problem with doing that is they're missing out on the external market for their jet fuel, and they're underselling themselves, underpricing the gasoline that it's buying for itself. So profit centers are charged with maximizing the profit of each division, and oftentimes that can work against the interests of the firm. Cost centers are charged with minimizing their costs of production. And basic rule of thumb is you want to charge the opportunity cost. Transfer pricing or transfer price should reflect the opportunity cost of whatever that intermediate good is. And if you don't have an external market, you want to operate as a cost center. If you do have an external market, then you want to operate that as a profit center. So let's take a look at a firm. Let's say a firm faces a daily demand curve of P is equal to 60 minus 0.01 Q. We can determine the marginal revenue curve from this and find that marginal revenue is equal to 60 minus 0.02 Q. And if we look and say with the marginal cost for the input, and let's say there's only one input in producing this final good, the marginal cost for that input is $20. Well, we can determine that the profit maximizing quantity for this firm is 2,000 units. You can plug 2,000 back into the original P is equal to 60 minus 0.01 Q and find the profit maximizing price is equal to 40. Therefore, the total revenue is $80,000. the variable cost, we're going to look at the margin, so the sum of the marginal cost. So $20 times 2,000 is $40,000. 80,000 minus 40,000 gives us a profit of $40,000. Now, what if instead the input division is run as a profit center? And let's assume that there is no external market for this intermediate good, and it's just been instructed to do a markup of 20% on the product, the intermediate product that it's going to sell to the production division to be sold to retail outlets. So now the marginal cost to the product division is going to be $24 because it's going to be marked up 20%. So 20 times 0.2 is $24. And now we can plug this back into our original equation, and 24 is equal to the marginal revenue, which is 60 minus 0.02Q, and we come up with a quantity is equal to 1,800. Plug 1,800 back into the original demand equation and find price is equal to 42. So total revenue is 75,600. It should be 75,400 minus 36,000 is $39,600 in profit. Notice that that's less than the $40,000, and the reason for that is the company is charging with the markup, so you now have a markup on top of a markup. As the intermediate division started charging for the 20% markup, that means the marginal cost to the product division went up, and therefore they had to raise their price, which caused a reduction in sales for the final product. And so this is why you want to be careful when you have a multi-divisional form. You want to make sure that if there is no external market for the good, you want to run it as a cost center. When there is an external market, you want to run it as a profit center. So again, the couple of examples to look at would be besides Mervyn's and Delta, taking a look at, say, HP and toner cartridges. As the printer manufacturer sells printers, they tend to come with a installed toner cartridge. It buys that toner cartridge from the toner division of Hewlett-Packard. The toner division is run as a profit center, and it should be run as a profit center because there is an external market for the toner. The company is maximizing profit not only across the printer, but also the printer and the toner. So it wants to maximize profit by charging the printer division the market price for the toner that it sells to the printer division. That'd be one example of this. Again, you look at Delta with the fuel. It wants to charge the market price to the airline division in order to maximize the joint profitability of both units or both divisions for the company. Mervyn's is the same way. Now, an example where you don't want to see this is a company or a product that has a input for which there is no external market. You don't want to do a double markup on that, so therefore that should be run as a cost center. That's going to be the end of our discussion on corporate structures.